There's a 3-digit number sitting in a database right now that decides whether you get approved for an apartment, what interest rate you pay on a car, whether an employer hires you, and how much you'll spend over your lifetime just to borrow money. Most people have never seen the full report behind it. Today, you're going to understand exactly how it works, where it actually reaches into your life, and exactly how to fix it fast. Your credit score is a number between 300 and 850. That's it. 3 digits. But those 3 digits follow you into almost every major financial decision you'll make as an adult. 2 Americans can walk into the same bank, ask for the same $30,000 auto loan, and walk out with completely different lives attached to that loan. Sarah has a 620 score. She gets approved, but at 14% interest. Over a 6-year loan, she pays roughly $14,000 in interest alone. Marcus has a 780 score. Same car, same price, same bank. He gets 6% interest. His total interest over the same loan term is around $5,700. Same car, same debt, same lender. An $8,300 difference. Just because of a number neither of them can see printed anywhere that most schools never explained. That gap doesn't stop at car loans. It follows into mortgages, credit cards, apartment applications, insurance premiums, and in some states, even job offers. A low score doesn't just cost you approval. It costs you money every single month for years in places you might not expect. Loans and credit cards are the obvious one. Every interest rate you're offered is priced against your score. Housing is less obvious, but just as real. Landlords routinely pull credit reports before approving an application. A low score can mean rejection or a landlord demanding a larger deposit. Auto and home insurance in most states legally allow insurers to factor in a credit-based insurance score when setting your premium. Employment in many states allows employers to check a modified version of your credit report during hiring, especially for roles involving finance or security clearance. Add all of this up, and you start to see why this number is bigger than will I get approved for a loan. It's closer to a financial reputation that follows you into rooms you didn't know it was invited to. So, let's break open the black box. What actually builds this number? Your score comes from 5 factors, and they are not weighted equally. Payment history, roughly 35%. This is the single biggest factor. Every bill you've paid on time and every one you've paid late is recorded. One payment 30 days late can knock your score down significantly, and it can sit on your report for up to 7 years. Credit utilization, roughly 30%. This measures how much of your available credit you're actually using. Under 30% is considered safe. Under 10% is considered excellent. Utilization is usually measured off whatever balance gets reported at your statement closing date, not your balance today. You can pay your card off in full every month and still show high utilization if you don't time it right. Length of credit history, roughly 15%. The longer your accounts have been open, the better it looks. This is why closing your oldest credit card, even one you never use, can quietly hurt you. Credit mix, roughly 10%. Lenders like seeing you can responsibly manage different types of credit rather than just one kind. New credit inquiries, roughly 10%. A few inquiries close together can make you look desperate for cash, even if you're not. Here's something most people get wrong. Your income has 0 effect on your credit score. Your bank balance has 0 effect. Your age, your employer, your education, none of it touches this number. Quick pause. Drop your current credit score range in the comments right now. 600s, 700s, 800 plus. And if this is the first time you've actually understood what builds this number, hit subscribe, because next week's video walks through the exact credit card strategy that gets people from good to excellent in under a year. On a $350,000 mortgage over 30 years, the difference between a 620 credit score And a 760 credit score can mean paying over $70,000 more in interest across the life of that loan. Credit card APRs tell the same story. With excellent credit, you might qualify for cards in the mid-teens. With poor credit, you're often looking at rates in the high 20s or low 30s. This is the part nobody explains in school. Your credit score isn't a school grade. It's a pricing mechanism. A low score doesn't just close doors. It makes every door that does open more expensive. Myth. Checking your own score hurts it. It doesn't. Checking your own report is a soft inquiry, and it has zero effect. Myth. Carrying a small balance improves your score. It doesn't. Paying your balance in full every month is always better. Myth. Your score resets to 0 if you don't use credit for a while. It doesn't reset, but it can go stale if there's no recent activity. Myth. Married couples share one credit score. They don't. Credit scores are individual, even for spouses. Step 1. Check your actual reports from all 3 bureaus. Look for errors. Disputing one that's actually wrong can raise your score within weeks. Step 2. Attack your utilization first. Paying down a maxed-out card from 80% to under 30% can move your score in a single billing cycle. Step 3. Never miss another payment. Automate it. Step 4. Leave old accounts open. Step 5. Space out new credit applications. Step 6. Become an authorized user carefully. Step 7. Ask for a credit limit increase on an existing card. Your utilization percentage drops instantly. The number that used to control your options is now something you control. Take these 7 steps, apply them in order, and check back on your score in 90 days. You'll see the difference. That's how you fix it fast.